Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode number 248, Cashing In, Liquidation Strategy and Your Financial Plan. Hello, Joe. Welcome back to the show.
Good morning, Cory. It's always good to chat with you. Happy to be back.
It's good to have you back on Upticks. And for those at home watching and listening, Joe Ibarra is a CPA. Joe works on the financial planning team with all of us at Falcon Wealth Advisors. And Joe and I work very closely together with all of the clients that we work with. So Joe, we're happy to have you here today. We're happy to talk about cashing in, liquidation strategy, and what that means in someone's financial plan. But before we get into all of that, Joe, what's new with you?
Good question. I guess the biggest thing that's new with me is my wife and I bought a home earlier this year, and ever since then, we've been doing some pretty major renovations on it. So week to week, month to month, lots of things change. And right now, we're not quite in the home stretch, but all the plumbing, electrical, walls, those are all up and running. So we're almost to the finishing touches, which is exciting. It's been a little bit of a long haul. We've learned a lot, but it's been fun.
Good. We're all excited for you, Joe. I know I've seen some of the progress you guys have made along the way. And I'd imagine there's a lot of people that watch and listen to this show that have thought about doing exactly what you and Killian are doing, Joe. I'm just curious from your point of view, how has the whole process gone relative to your expectations before you started?
I've been joking that the process has gone better than expected. It's gone relatively smoothly. Costs have been as expected. Work has gone as expected. But I joke that that might be a bad thing because it may tempt my wife and I to do this again. And I feel like we've had an exception of an experience. And if we do ever do this again, it may not go as well. So in my experience, it's gone fairly smoothly. But I can see all the ways that it could go wrong. I'll put it that way.
Yeah, if the beginner's luck might wear off on you and Killian if you guys try it again next time, Joe. So
exactly.
Well, yeah. Good. Well, all the best to you guys as you finish up that project. I'm sure you're excited to get moved in. Again, I am stepping in and pinch hitting for Jake and hosting the show today, as Jake and his wife Rachel are traveling on a well-deserved vacation. So we're happy for them. They are in Europe, actually. We're looking forward to talking to Jake more on the show about their trip when he gets back. But as far as today's show goes, we're going to talk about liquidation strategy, which might sound boring, frankly, or not exciting to people. But I think that this is a crucial aspect of each and every individual's financial plan, which is a big part of what we do at Falcon Wealth Advisors. So we're going to spend some time talking through this. But before I get into all of that, just as a quick reminder, make sure you're subscribed to the show. If you like the episodes, if you don't want to miss these new episodes as they come out, you can subscribe, whether that's on YouTube, if you're watching the video, wherever you listen to your podcasts. And of course, if you like the episode, we of course appreciate a thumbs up rating, 5 stars, whatever it may be, because that ultimately helps other people find the show. And our intention here is to educate and to give people actionable ideas and considerations for their financial lives. So to get it kicked off, Joe, I've teased it a little bit, talked about this liquidation strategy. What exactly is a liquidation strategy in a client's financial plan?
I think the best way to describe a liquidation strategy is making a comparison to I'll use a throwback phrase here to grade school mathematics, and it's very similar to the order of operations. If anyone remembers when you're doing a calculation that has parentheses and exponents and a bunch of other things, there's a specific order of operations that you have to go through in order to solve it. In a similar way with someone who has different retirement accounts, different kinds of accounts, the liquidation strategy is the order of operations that we use in terms of which accounts to pull from first. Now, it might be a combination of multiple at the same time, but I think the best way to describe it is the order of operations. And this isn't something that clients always think about because it's a little bit more behind the scenes, but it's an important function nevertheless.
Yeah, absolutely, Joe. And I think it's really just the approach for how you're going to convert your investments and your assets into cash to live off of that cash as you need it. And thinking about retirement, it's important for people that are retired. This is also important for people that are still working. But really, the intention in a well-designed liquidation strategy is to take a number of different items into consideration. So, Joe, can you just kind of, from your point of view, when you think about the financial plans that we run for clients and think about the liquidation strategy that we approach, in your words, what is it that we're really aiming to accomplish? What are we trying to do when we're designing the liquidation strategy?
That's good. The first thing might sound a little obvious, but the first goal will be to maximize the funds or assets in the account. The reason why I say maximize is depending on which account you pull from at which time may be more or less efficient. So that's kind of an obvious answer. I'll maybe take it a step further and say one of the other things we're trying to achieve is a certain kind of tax efficiency. Obviously, when we're talking about which accounts to pull from first, it's not as important if there are two different IRAs. Not going to make a whole lot of difference which one of those we pull from first. But this becomes more important when there's, let's say, a Roth IRA, a traditional IRA, and maybe a brokerage account. So when we pull from which account makes a big difference in terms of the tax efficiency. Obviously, if someone is in a high tax bracket situation, we'll want to be mindful of which account we pull from to not add on top of that. Conversely, if someone is in a low tax bracket situation, we might want to pull from an account that generates taxable income. So I would say tax efficiency is probably the second item. And then the third is kind of a step further from that is we can look at different time frames. If a client is really just concerned about their own portfolio and their own lifetime, which is usually the case, there might be one strategy. But if we take a step back and we say, what about the lifetime of the assets themselves? That also might change things a bit. So I think portfolio value, taxes, and even taxes of the life of the assets themselves are all things that we can try to maximize that makes a difference here.
Yeah, that's really good, Joe. And I was thinking as you were talking through that, IRAs, Roth IRAs, brokerage accounts, et cetera. We've talked about tax diversification for clients on the show, and we'll continue to talk about that. I think, though, even beyond the scope of just investment accounts, right? If someone has land, if someone has real estate, if someone has collectibles, think really any asset that you can liquidate when there's value involved, or it is an asset that you plan to liquidate at some point in your financial plan or at some point in retirement, taking into consideration when that's going to occur, the tax implications of the sale of any asset, and then ultimately living off of those dollars, what's the impact on taxable income? Because ultimately taxable income drives a lot of different considerations for somebody in retirement in their financial plan. So I think all of that fits in together when you're thinking about while someone's working and saving and accumulating, when they are retired and spending and liquidating or selling their assets, whatever they might be, what's the most thoughtful and appropriate way to do that, and how can we optimize for tax efficiencies along the way?
Yeah, that's a good point. I like the way you bring up the savings component because obviously we do a lot of planning and intention around what's the best account to save in and at what time. And I think sometimes we can forget that on the flip side, when someone is retired and pulling from the accounts, there's just as much thought that goes into how the funds come out of the accounts. So I think that's a good way to describe both sides of the same coin.
Yep, very good. Well, thank you, Joe. For someone who's still working and they are not yet retired, they're not yet liquidating and living off of the assets that they saved, for someone who's still working, what do they need to know when they're thinking about their own liquidation strategy in the future and their own financial plan?
On a similar note that I just mentioned, I think it's important that when we look at the liquidation strategy, let's say first, and we think about what are we planning to do when someone is retired, I think it's important to look at the savings component and say, let's make sure that we're saving in a way that doesn't conflict with what we're about to do when someone does retire. A good example might be if someone wants to retire before age 59 and a half, and they want access to funds. And let's say we're planning on them using funds from a taxable account in the time frame from retirement to age 59 and a half. it may not make a ton of sense for someone to be overloading their 401k and not saving anything in that taxable account, because that would be conflicting with our whole goal of needing to have taxable dollars. In a different sense, if someone is not planning to use funds for a really long time and they've already built a good pre-tax bucket, we might say, let's start saving in Roth, because we know that when we look at the liquidation strategy, those Roth dollars are going to be saved for last. So I think it's important to have the two conversations at the same time, because how you save is going to be is going to obviously be related to how you withdraw. So I think just having the conversation and making sure that both aspects are working in alignment.
Yep, that's great, Joe. And I think you highlighted that really well. I mean, you and I have meetings with clients, virtually every day, and have discussions with clients about this every day. And I do think that, what I've seen as a common example of someone who is working and saving that may not be considering or looking at the big picture is what you just described. Somebody who may be looking to retire in just a few short years. They may not yet be age 59 and a half when they can access those retirement dollars. And the reality is they might be putting 25 to 30% of their income in their 401k, which, don't get me wrong, saving the money for retirement is not going to hurt anything. But to your point, the liquidation strategy, the savings, and the withdrawal strategy that are all part of this financial plan for the individual really tells us that that may not be the most effective way to save, because that may not be aligned with the objective of ensuring there's dollars to take distributions from and not have to worry about paying any tax penalties. So it all sort of fits in together.
I think that's a great point. And maybe one additional account to throw into the mix of different accounts to think of is, I would say, someone's savings account at their local bank really falls into the liquidation strategy as well. You might think that if someone is planning to make a big purchase or do something in the short term, in terms of liquidation strategy, it may not make sense for us to put those funds into a Roth IRA, because if they're going to use it immediately, it may be better off for just keeping funds in a savings account if they're already there. So it's almost like a waterfall or a hierarchy, and we want to make sure that the funds you're planning to use first are in the right spot, so that the money kind of flows in a way that it's in the account that you are planning to pull from at the time you want to pull from.
Yep, that's great. And I think that's very useful and important for people to understand and consider in their own financial plan. And that's obviously that's the main reason that we host the show. We put this out each week, is to help people understand what their financial plan means to them. So the one point that I can't stress enough about all of this is that it's not going to be the same from person to person. In all likelihood, it's going to look different for a myriad of reasons. And that really takes me to the next question, Joe, which is, you and the financial planning team, when you are working through the financial plans for clients, building out financial plans for new clients, what comprehensive information do you need to really be able to build an appropriate liquidation strategy for a client, or at least evaluate it?
Sure. I would say, maybe to preface, in the beginning, I mentioned a kind of order of operations. Mm-hmm. And in math, the acronym is PEMDAS, parentheses, exponents, so on and so forth. For us, I would say, as a general rule, the order of operations would go taxable account first, pre-tax IRA second, Roth IRA third. And I just offer that as a general rule. And now I'm going to talk about what someone's specific situation might be in order to deviate from that general rule. The first, I think, that's most relevant is someone's taxable income situation in retirement, because, as I mentioned previously, tax efficiency is probably one of the most relevant items when constructing a liquidation strategy. So if someone is in a particular situation, even in retirement, where they have lots of taxable income, pensions, Social Security, maybe they're at RMD age and they're already taking large distributions, the money we use to supplement all of those things may deviate from that general rule. I think another thing is someone's goals, which is kind of a vague thing to say, but I'll give you maybe one example. Let's say there's a client who, generally speaking, has more than they need, and they are planning on they're planning on having their assets go to beneficiaries in the future. If they have a specific goal of trying to ensure that the assets pass to the next generation in a tax efficient way, it may be helpful for us to pull from a pre-tax account first, essentially prepaying some of those taxes and either converting it into a Roth IRA or keeping it in a taxable account so that when assets do go to beneficiaries, there are dollars available that won't be taxed at ordinary income rates in order to pay the taxes for maybe all the dollars that are left in that IRA. So I would say financial situation, but also maybe on a more personal sense, just simply someone's goals and what their plans are for the funds. Those two things, I think, drive most of our liquidation strategy design.
Yep, that's really good. What type of investment accounts do you have? What's the lifestyle and the spending going to look like in retirement? What are some of the big picture goals, Joe, that you've mentioned? What other sources of income? All of that comes into consideration. But we have looked at this with a number of clients when we are sitting in our client review meetings and we evaluate or optimize the liquidation strategy. And we've seen it can make a very, it can have a pretty meaningful impact on someone's financial plan, particularly if they have specific goals that they're trying to accomplish. There could be great ways to achieve those. And that's exactly why it's important for people to evaluate this. So what other elements and considerations, Joe, would you take into consideration for the liquidation strategy, like the asset allocation, the withdrawal rate? How does all of that fit into the big picture?
Good. I'll maybe just start with the first item that you mentioned, asset allocation. I think understanding the timeline for different accounts is helpful. I'll use a Roth IRA as the first example, and I said that in the general rule, that will likely be the last account. So if we just imagine that in someone's liquidation strategy, we're going to pull from all the other accounts first, save the Roth last. Theoretically, that Roth account is going to be growing tax-free for a long period of time. So that's the account that we would want to have the most aggressive positions in. So obviously stocks, things that we are hoping to have, great long-term growth. On the flip side, let's say the taxable account is the one we're going to pull from first. That account should be more fixed income and conservative because we're expecting to be using those funds sooner. So I think, in a twofold way, there's a really short-term strategy, and then there's a long-term one. And you had made a good point just a moment ago about the impact being larger than you might think. And I think it's important to look at that both in the short term. Maybe a good example of that is if someone is wanting to purchase a second home and they have funds set aside for that, hopefully that's in a taxable account so that we can take all the money out at one time and not have a big tax hit. So it can be important in any individual tax year, but also as we think really long term, pulling from one account or another every single year over 1 or 2 decades is going to make a big difference as well. And then maybe I'll touch on one other thing you mentioned, which is withdrawal rate. The percentage of how much money someone is pulling from their account in any given year also makes a big difference. Like I said, with the Roth IRA being last on the list, if someone has a low withdrawal rate, it's probably the case that we can let the Roth dollars grow for a long period of time. If someone is pulling a lot of funds quickly, it may make more sense to tap into Roth dollars because if it's going to be spent in the short term anyways, and that's a bucket that's going to be used, we might want to take advantage in a particular year of using the tax-free funds in conjunction with probably a couple of other buckets. So I think asset allocation is a good example. I think looking at a specific tax year or multiple over a long period of time, those are things to consider as well.
Okay, that's helpful, Joe. Thank you. Let me throw a curveball at you here. What if someone who's watching or listening to the show says, okay, Joe and Cory, this is good. It's helpful. I understand what it is that you guys are saying, but I'm retired. My wife and I have pre-tax retirement accounts. We had 401ks that we rolled over into IRAs, and maybe we have a pension or Social Security, and that's about it. We don't have any property or land or anything else to sell. We don't have any Roth IRAs. What would you tell someone like that, Joe, as far as their liquidation strategy?
And just to clarify, you said that they might only have one account. It's just an IRA?
Yep, all pre-tax dollars is all that they had because that's how they started saving in their 401k 30 years ago, and they didn't do anything else. But each time they pull money out of the account, they have to pay income. What would you tell someone in that situation? Because we have a lot of clients that are in just that situation about how to approach their liquidation strategy.
That's good. I'll say two things. The first is if the numbers align and the withdrawal rate that we are expecting for that client in particular is going to be very consistent and it aligns with their RMDs over a long period of time, I would say we could have a really simple liquidation strategy and simply just pull from that one account over time, and things might align very well. But even if that's your only account, it's still possible that we could have a more complex liquidation strategy, because if you consider a scenario in which we might pull more money out of that one IRA than someone might need in a particular year, so that we could do one of two things. We could put money into a taxable account, start building that up, so to speak, kind of like saving in retirement for maybe a big one-off purchase that you're envisioning down the road. Or we can take money out of that pre-tax account, convert it into a Roth IRA, because we want to have that long-term tax-free growth. So even if it's just one account, there still are considerations that we would say maybe we need to move funds from that one account into others for all the reasons that we talked about. So while it's possible to have a super simple liquidation strategy and just pull from one account over time, that may be relevant. But even if that's your only account, we might want to open new ones, fund those new ones, and use them accordingly.
Exactly. That's good, Joe. And that's really what I was thinking I was going to glean out of you and asking that question, which is that even if all of your money is in a pre-tax retirement account, it doesn't mean that you shouldn't take the liquidation strategy into consideration, because there may be years to take advantage of filling up low tax brackets with distributions, considering charitable gifts. If that's a goal or a priority of someone, there are ways as somebody approaches the required minimum distribution age, but they can take money out of a pre-tax account, gift it to a charitable organization, and they don't have to worry about paying income taxes on it. That would fit into a liquidation strategy as well. So again, I really think this is pertinent for just about everyone.
Yeah, and that's a great example, because I've talked about how, at least for a pre-tax IRA, there are some considerations in which we'll want to pull money out of that account sooner than later, and maybe do so consistently, so that RMDs don't build up later in someone's financial plan. However, if someone's particular situation says that they're planning on being charitable, then maybe not paying taxes on those IRA dollars sooner than you have to is best. Saving it for when you get that QCD benefit. That's a great example of a contradictory reason why you might want to save and keep dollars in that pre-tax account for as long as you can. So I think the short story there is our job is to try to get all of those details, to look as far into the future as we can, because the liquidation strategy will change over time, and that's not a bad thing.
Yep, that's good, and help clients understand what their plan means to them and what their liquidation strategy means to them. That's really good, Joe. Thank you. And I didn't comment earlier. Nice work, Joe, in reference on PENDAS, going back to the order of operations. I didn't comment on that. I kind of moved past it, but I wanted to make sure I came back to it. Well done there. So lastly, Joe, any misconceptions? What are some common misconceptions, in your opinion, that people have about what we're highlighting here today?
That's good. Maybe first of all, elaborate on a comment I just made, which is that even if we are diligent and we set up a good liquidation strategy, it may be a misconception that that strategy can't change over time. And I would say, in some sense, if we pick a liquidation strategy and it's working well, it's probably the case that it will continue to work well for a long period of time, and we won't have to make any changes. However, as we know, life happens, things change, the tax code will change, the rules from Congress will change, someone's personal goals will change. So I think it's important to keep in mind that this probably falls more into the long-term strategy category, something that we will execute for clients over a long period of time. But that's not to say that it shouldn't be reviewed pretty regularly, because if one of these items comes up, I think it should be on a client's radar that it's okay to change. So if you hear us making a suggestion that we're going to change which account we're pulling from, you might ask yourself, well, why weren't we doing that previously? I would say based on the numbers, based on the conversations we have with the clients, a liquidation strategy can certainly change. And I think it's good for us to be open to that. The second misconception I would say is probably the general idea that you should let your pre-tax IRA grow for as long as possible, and you should defer the taxes for as long as possible, and maybe that should be the account that you pull from last. Just to kind of unwind that a little bit, there are several reasons why that may not be the case, but maybe the most important is, as we all know, the RMD age has been pushed back a little bit, and there will be a point in time in someone's life when the government says you've been deferring these taxes long enough, time to take money out of the IRAs, pay the taxes. If we're really hands-off and we let those funds grow and compound, people may find themselves in a situation where when they reach that RMD age, they're going to be paying high taxes on high dollars because we've kind of let that snowball. So I would say there's almost this unorthodox strategy where we actually want to pull funds out of the IRA even before we quote unquote need to, just because we can smooth that tax liability out over a longer number of years. We can move those funds into Roth IRAs or even a taxable account if that's necessary. So I would say that's a very common strategy, is just to let the IRAs roll, but that may not necessarily be the case. And I think you and I have had a lot of conversations over the years for clients in which that's really true. And I think we've done a lot of good planning for them in particular.
Yeah, that's really good. And I think it is that's a perfect example of just a misconception that people have and how it can make a difference in someone's financial plan. And that's why we do want to keep the short term and the long term in focus and in mind when we're thinking about someone's financial plan. I think there's misconceptions too, Joe, where somebody thinks that I've retired, so therefore I shouldn't take any risk with my money that's invested. Or someone thinks I've retired, I don't have as much money saved as I would like to have, so therefore I should take more risk with the money that I do have. Both of those are misconceptions. Nothing, the decisions aren't made that way in a vacuum. But we have a lot of clients whose asset allocation is designed to align with their liquidation strategy. So they can take distributions from these accounts appropriately in retirement. We know what's going to come from where and when. That's the whole idea there. So the thought that someone should drastically change how their money is invested, or they need to lock in whatever the plan is in perpetuity and leave it just the same. I think you made a great point, Joe, earlier that frankly, almost everything is temporary in a sense when we're thinking about the long-term financial planning, because things change. I've likened it with clients to a conversation of like you're trying to put together a puzzle, but the pieces change shapes while you're trying to do it. That's really kind of what the financial planning, that's what the world is, because things change. And being diligent about staying on top of it, making sure that you understand what your plan means and what is reflected in it. And also that you're communicating with your advisor, communicating with us as things change. That may have an impact on how we approach things for you. So that's why we want to make sure we have those conversations and recognize the fact that this is not a one-time exercise. It's an ongoing process.
Yeah, that's good. I just want to reiterate that it's not a set it and forget it strategy. Usually a good liquidation strategy will involve pulling from multiple accounts at the same time. So there's a little bit of fine tuning there. And I think it's important for clients to let us know if their plans change, both in the long term, in terms of what their long-term picture is, in terms of estate planning, beneficiaries, where they want the funds to go, but also in the short term. If new goals pop up, there's new relevant income. I think these are all things that we like to hear because we just want to have all the information. We can crunch the numbers on the back end and then provide the actual strategy. So I think that's a good reminder.
Excellent. Thank you again for taking the time to come on the show here today and talk this through. I know we are kind of bumping up against the clock here, so appreciate everybody watching and tuning in and listening at home or out and about, wherever you may be. Make sure you subscribe and rate the show. If you have any questions, if there's anything that we can help with, don't, of course, hesitate to reach out to us. My email address is just Cory@FalconWealthAdvisors.com. Joe's is joe@falconwealthadvisors.com. But ultimately, all of us in the company are here for you and for all of the clients that we work with. So, Joe, thanks again, and we will see you next week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.